Hello and welcome to Moneylife News and Views. I am Debashis Basu. The Securities Exchange Board of India a few days ago issued a strong preliminary order against Jane Street, which is a New York-based trading firm. It accused Jane Street of orchestrating large, synchronized trades across cash, futures and options market to manipulate equity index levels. The trades allegedly profited Jane Street handsomely, billions of dollars, while inflicting losses on India's ever-hopeful retail investors. In a righteous indignation, SEBI declared that the integrity of the market and the faith of millions of small investors can no longer be held hostage to the machinations of such an untrustworthy actor. SEBI has banned Jane Street from the Indian securities market and impounded 4,843 crore in alleged unlawful gains. We will watch with interest how this case progresses. After all, the Indian judicial system is notorious for routinely letting off untrustworthy actors escape the due punishment. But what does the episode reveal about India's derivatives market itself? Popular reformist responses to the Jane Street saga are both predictable and misdirected. The suggestions include beefing up surveillance, raising margin requirements, curbing expiry date trades, and educating retail investors about the risks of option trading. Foreign and domestic traders should be treated equitably in tax matters. It's all very sensible, but they are peripheral. If we do ask, as Romans would in a similar situation, which is cui bono, that means who gained an advantage which can help to identify suspects or motives, then the answer becomes absolutely clear. Remember, we have been here before. SEBI's own study from 2023 laid bare a very sobering statistic. Over 90% of individual traders lost money in trading futures and options in FY22. The regulatory response: pop-up warnings on trading platforms, a useless daily irritation while logging in for traders. I had mentioned then, nothing will really change for investors because whether traders win or lose, one group always gains: the rent collectors of the stock market system, who also happen to be the rule makers. The answer to cui bono is in plain sight, not even hiding. According to SEBI's 2023 analysis, in FY21-22, over and above the net trading losses incurred, losers in the group of active traders were out of pocket by an additional 28% of net trading losses as transaction costs. Now, even active traders making money trading profitably incurred 50% of such profits as transaction costs. Transaction costs for traders are in turn revenues for three entities. Apart from the smart high-frequency traders like Jane Street, this trinity, always invisible, is the state, the exchange, and the regulator, which is the exchange, which is a market regulator. They feed off the steady churn of hopeful punters in the derivatives market. There are no incentives for any meaningful reform if they themselves, who are beneficiaries of such frothy trading, are also rule makers. Number one, the central government. Securities transaction tax revenues have exploded from just 6,426 crore in FY15 to an estimated 55,000 crore in FY25. That is 24% compounded annual growth in revenue for the government. More than 40% of this likely stems from F&O trading. Whether a Jane Street games the system or not, or whether 90% of F&O traders lose money or not, is all peripheral. The government has been the biggest beneficiary of the F&O casino. Number two, the exchanges. Derivatives are also the golden goose for Indian exchanges, with almost all the money going to National Stock Exchange due to its near monopoly status. NSE began offering co-location services to high-frequency traders in 2009, illegally according to us, and now rakes in colossal revenue from derivatives estimated at 15,000 to 16,000 crore in FY25, accounting for 90% of its total income. In March quarter, net profit jumped 47%. Its dividend an eye-watering 3,500%. Operating margin stands at a cartlistic 78%. In 2015, NSE was racked by a co-location scam, and in 2025, it had to be goaded to send a warning letter to Jane Street by SEBI. They have no interest in changing anything. NSE has every incentive to expand the casino, not regulate it. It has even less of a motivation than Ministry of Finance to cut down on FNO. Third, the Securities Exchange Board of India itself, even the regulator, has a big stake in the status quo. In FY24, SEBI earned 1,851 crore from regulatory fees and subscriptions. Of these, 1,066 crore came from turnover-based fees, driven largely by the FNO segment, which accounts for 90% of total trading turnover. Venture capitalists often ask startup founders for a crisp problem statement. That is, what is the problem you're going to solve? In this case, what is the problem that we are going to solve, or the rule makers or the policymakers going to solve when talking about the FNO market? It is not how to prevent Jane Street type of market manipulation or how to protect so-called innocent investors from losing money. It simply is this: what is the socio-economic benefit we are deriving from the current derivatives market? SEBI claims that FNO enables efficient price discovery, improved market liquidity, and permits investors to manage risk. I humbly state that it does not do any of these things. Anybody who understands the market and who trades closely or invests closely and watches what is going on in the cash market and derivatives market will know that the cash market runs parallel to the FNO market and hence does not aid in price discovery or liquidity, and only a small number of investors use FNO for hedging. The rest is socially harmful, speculative frauds. In July 2023, stock derivative volumes were 422 times that of underlying cash market. Are we talking about price discovery or hedging or liquidity here? In FNO, India has created a standalone, highly speculative market which has catapulted India to the top of the global league tables. NSE is now the world's largest derivative exchange by volume. In early 2024, perhaps 84% of all global index trading was occurring in India, according to IFA, an industry association. That's a peculiar badge of honor for a poor country where 800 million people, or 57% of citizens, received government food rations every month. One might forgive skeptics for wondering if India has built the world's most energetic casino in the name of financial development. Until India honestly confronts the question of who benefits from its frenzied FNO market, the answer to what to fix will remain elusive. But for now, the wheel keeps spinning on. If you like what you watch, please do subscribe to this channel and do share this video, definitely. Thanks for watching.